Hello and welcome to the Weekend Investing Daily Byte of 9th of September and another day where the broader markets was soft. Nifty opened gap down but then recovered more for most part of the day. But overall, it has been a sentiment of softness and weakness, and most earlier gainers, past winners of the various sectors are drifting down, if not falling down as such. Uh, Today's video we will discuss. First, today is the last day to subscribe to MI Evergreen at the old prices. Pricing goes up from tomorrow. This is just an update from my team. So, alarming surge in young traders. We will discuss this phenomena. Some statistics from ET and Mint will be presented, and more, you know, uh, sort of. Try to give my view on how this has really caught the attention of the young folks, and how maybe it is not going right for them, uh, but that at the second half of this session. First, please try to subscribe to the channel so that you can get the new notifications on your phone. Where is the market headed? The market quite resilient still, I would say. It opened slightly, kept down, went down further, uh, came back up 0.34% on the Nifty. So Nifty does not look half as bad as other sections of the market were, but this reaffirms that market is in no rush to go down. Otherwise, you would have seen, some big dollops of falls one after the other. I think that is certainly the news from the market, that reasonably stable going forward. Nifty Junior, if you see that support where it has come from, exactly from 40-day moving average, the support was there. The bottom clipped this and closed very near days high. That's always a good sign. So 0.515% on Nifty Junior. Almost all the weakness of the day recovered by the end of it. Mid caps also taking support at the moving average, uh, closing only quarter percent down. At one point, it was almost more than a percent down. So again, a decent recovery on that front. And small caps more down 0.83%, but small caps have been, on a different trajectory than other parts of the market, and that's how, small caps have been uh, doing well as well. So no damage done as such. I think a significant part of the market has taken some profit taking. Some stocks in defense or in public sector enterprise, public sector banks continue to fall. So there may be more fall in them. Those stocks that went up in a very exponential trajectory may be the ones that will fall more, and that's how the markets will normalize once again. Bank Nifty very nicely, almost recovered what was lost on the previous session, almost plus 1% up. I think Bank Nifty is the strongest mover today, and that is a always a good sign going forward, with Bank Nifty leading the markets up. Momentum trends, you can see advanced decline ratio, uh, almost, you can say, 2 is to 3, and the skew has been on the decline side for the last couple of sessions, but the fall today has been arrested, and that is a good sign on that front. FIIs continue to sell. This is figure of 6 September, so we will come to know about today's selling or buying later in the day. But DIIs continue to buy, and FIIs are, in the last two sessions, have sold. So there is no change from FIIs since the last two sessions. The previous 5 sessions were a good buying from FIIs, and the selling part, I think, also has reduced dramatically. Earlier in June, July, they were selling big amounts every day, and now it is reduced to a few hundred crores. ONGC, Tech Mahindra were the two, stocks that were badly hit. ICICI Bank, ITC, Hindustan Lever, Britannia, Tata Consumers. These were the stocks that really held up the Nifty. So a good balance between some stocks moving down and some stocks. There was no contiguous trend across sectors today. Nifty Next 50 also saw some drop in the PSE finance stocks, so REC, PFC, uh, uh, IRFC, all these stocks were down, although they did recover from their intraday lows. Bajaj Holding has dropped after several days of running up. VBL, Dabur, United Spirits, Godrej Consumer, Marico, Chola Finance, all of these stocks were up along with Bosch Limited. Other than these, they were pretty much on the muted side. Sectoral trends, FMCG saved the day for the Nifty. So FMCG has been put into service again. So FMCG will always come into play whenever markets are a bit soft, being the defensive part of the market. So usually FMCG, pharma, and IT lead on bad days, but today IT was clobbered minus 0.7% today. Although on a 3-month basis, IT still is leading all the sectors. Public sector enterprise stocks definitely lost significantly more today, minus 1.5%. Energy and metals also losing 0.7% each. Private banks was a big change from recent times. Private banks actually leading the bank nifty also up, and consumption stocks also leading up ahead of the festive season at 0.9%. So good balance between some sectors going up and others moving down. You can see the ones on FMCG, index moving to a new high uh, with levers, Godrej Consumer, United Spirits, United Breweries, Dabur, Varun Beverages, ITC, Britannia, Marico, and Tata Consumer all doing well. So very, very good sort of contiguous and spread out FMCG run today. Stock Spotlight was on APL Limited, was up 8.8%. It had been running up earlier in June, July, August, and is now recovering again to new highs. So, stocks doing very well on reasonably poor days are to be watched out. This, I think, is a wrong chart. It should have been APL Limited, but Alembic Pharma is also doing well. APL Limited is, yeah, Alembic Pharma in short there. Uh, Alarming surge in young traders. So this is the topic of the day. This is some statistics that has come out is that, of course, in 2023-24, 9.2 million individuals and proprietary firms have incurred a loss of 51,000 crores. Out of these investors, 85% lost money and 90% ended up in losses. This is already known to you. This was a SEBI report that came out. And this is how the registered investor base at NSE has been going up. So in March 2020, you had 31 million investors, and in August 24, in just little more than 4 years, you have 100 million investors on the NSE. While you may say that several of them may be inactive, but even then, I mean, whatever percentage of discounting you can do, there has been a very steep rise of investors coming to the markets. Now, as prices go up, it attracts more and more people uh, to the markets, and as prices go down, it will obviously have more and more people go away from the market. So this is the natural cycle uh, that plays out as the rally goes on. People will get FOMO, and people will say, I've missed out, let me also jump in. And as things cool off, when there will be no short-term returns, some may give up, and so on and so forth. So one very unique thing that has happened is, this is sourced from Mint, is that young investors have dramatically gone up. So in since March 2018, in 6 years, approximately from 22-23% participation to 40% participation by unique investors under 30 years. 30 to 40 years has gone down just a bit. 40 to 49% is also down. 50 to 60 years is also down. 60 and above is also down. So essentially, young investors have really ruled the new wave of investors coming into the market. And obviously, when you have come into the markets and the markets have been buoyant all these years, 2, 3, 4 years, and we haven't seen even a 5% drop in markets, I think, since COVID times. So a lot of these folks have not yet seen any bear market and no experience on that side of the market. So building that expectation is very important at this stage. So so that people should not be expecting that the next 4 years can be similar or better than the last 4 years. It may be, but it may not be also. So given that we've had much better than long term average returns in the last 4 years, to expect that the next 4 years will also be much better than long term average is is somewhat high hopes, I would say. I mean, in the sense that if we do get there, that will be amazing. I mean, it will be like that long term averages have changed and this time it is different. But markets are cyclical. I mean, money moves in stocks, they become overbought, they become overowned, and at some point of time, money moves out and they become underowned, and then the cycle starts again. So it's like a pendulum that continues to go on and off, and not expecting that is actually not natural. Expecting that the market will do this is natural. Expecting that the market will continue to rise, I think that is living in a very utopian dream. And I, of course, I hope and wish that that dream comes true. But given my 29 years of experience in the market, that usually does not happen. Intraday trading also has surged tremendously, 1.5 million to 6.9 million traders. This is just the top 10 brokers, and this is data is also dated by a year and a half now. On average, 71% intraday traders losing money, increasing from 65%. So most people, you can say most people are losing money. Most people are not making anything significant in the market. If you look at the capital gains filing of last year, you will find a very small handful of people having maybe more than 5 lakh rupees capital gains. So there is a lot of participation, but there is a lot of you know losses, lot of rejection, lot of you know basically losing capital that goes on. And SEBI, in its own wisdom, and what can SEBI do, is trying to curb or limit this euphoria. um, so a lot of influencers were promoting brokerages. I mean, this was actually not right, in the sense that you are influencing somebody else to invest just because you are able to influence them that what you say is right. And so you are saying, come and open an account at XYZ broker, and the broker is paying you for that. So that you know is a sort of a mis-selling activity that was going on. And of course, now SEBI has curbed that and ensure that there is more accountability, and people don't really go ahead and use their influence to market brokerage firms. So brokerage firms have ceased payments to influencers as affiliates. And of course, because they wanted more business, they hired more and more influencers, and those influencers went around touting the great um, you know uh, mobile application features, and how does the low brokerages work, so on and so forth. So this, now I think we are at that point where uh, that unbridled euphoria is getting hit, and things are sort of gradually getting uh, you can say focused at by the regulator, by finance ministry. Options are, there was a increase of 100% increase in options pricing, options taxation. So all that, and capital gains has also gone up. So all that curbs the unbridled enthusiasm that is there in the market, and hence that it can also lead to more consolidation in the market, long periods of time when you may not see euphoria. Like, it is like SME also is getting into focus, and the regulator is looking at how to curb the SME operation also. So market will try to find ways where some action happens, and regulator will try to curb that great euphoria so that people don't lose their money doing that. Although a lot of times you can't really curb the greed a, of an investor. Like, regulator says it's a question of protecting the uh, innocent investor. Now, if the investor wants to double their money overnight, um, I mean, it is their greed that is calling them. And many investors are aware that what kind of risk they are taking. They're saying, okay, if I have 100 rupees, I'm willing to take a risk on 10 rupees and improve my life if it does so. So there is a very strong case for, having free market, while the other case is, that we want to control what kind of pricing, what kind of valuation, what kind of people come into the market. So it's a very tricky business, being there. So all those who are here who have not made money in the last few years must rethink their strategies, because if in the last 3, 4, 5 years, if you've not been able to make money in the markets, you must relook at what you're doing. Uh, this probably was the easiest period to have made some gains on your capital. Um, so maybe if trading is not working for you, look at investing. Maybe trading is not your game. Maybe everybody's psychology is different, everybody's behavior is different. So, the discipline that is required for trading to be, at that cutting edge, and to be able to call quickly those decisions, can be there in some people, may not be there in a lot of people. So trading may not be your calling. And a lot of folks try to do it on a side, part-time basis, that they're working full-time in their profession, but on the side they want to do bank nifty trading and those things. It never works out. I mean, I can tell you, 1 out of 100 may work out. For 99 people, it will not work out. So, why? I mean, there are other ways of making decent money. Why would you want to sort of risk your capital and blow it away? So these are some of the thoughts that I have. I mean, you could be having some more thoughts. Do share us in the comments. Maybe it is the lack of jobs that is causing people to take to trading so that they can, bring home some money. That is also a logical sort of thought, that I'm not able to get a job somewhere, so why not I, try something in trading. So I think a lot of folks are getting misled, or uh, getting FOMO'd into trading into the market, because some of the folks that they may be watching on influencers and reels and all those things. So get some dose of reality, because I mean, I don't think it's actually so glamorous the way it is projected to be. And long term investing probably is a good way to have some consistency and compounding over long periods of time. But if you really have a knack of trading, I mean, start small, you know limit your whatever capital at risk. Try to do that. If you find that there is some encouragement in your trading, if you find that you are improving over some period of time, then of course take it forward. But don't blow up your parents money or your own saved money for the heck of trying to take revenge with the market, because that never works out. Thank you so much for watching. I'll see you in the next one. Bye.